Welcome to the call. My name is Troy Patton with Archer Investment Corporation. Today I want to talk about the third quarter market update and outlook. Obviously, it is perfect timing. The market's been very volatile the last not only few days, but for the last couple of weeks. Obviously, yesterday and even today, we saw very large downswings in the market, only to recover some of that. But I'd like to go through that with you today and talk about kind of where we feel it's headed. Should you be optimistic for the rest of 2014 and beyond, and really kind of where we're going to end up at the end of the day. Okay. Well, clearly where we're at today is the market's declined, although there's some positive signs in it. In the market. One of the things that I do want to talk about just briefly, because many of us, it's on our minds, is with this new Ebola scare. There's a lot going on, and it's clearly had some impact on not only the airline stocks, but on the stock market as a whole, as we've now seen the second Ebola patient. And quite frankly, I suspect there will be another 10 to maybe 20, even 50 more of these type of outbreaks. I would like to mention this, and although it is alarming and it is concerning, and clearly the fear trade is on in the market, we have seen this before. We saw it with mad cow disease, where McDonald's stock dropped to nearly $15 a share. It's currently at 90. We saw it with the SARS outbreak in 2002, 2003, where the market dropped quite an alarming rate. We've seen it with the Asian flu, or I think it was the swine flu or bird flu. And it goes on and on and on. There's a lot of these things. We could throw in the Vietnam era. We can throw in the tech bubble of 2000, the Great Recession of 2008 and 9. Again and again and again, we have things, unfortunately, that do come up. They impact the market. They scare the heck out of all of us, obviously. And I say all of us, my money's invested right along with yours in the same type of investments. And in fact, the majority of my investments are in the Archer funds directly, those funds that we manage, not just in the portfolios that we manage as well. So looking at that, I think we need to just kind of put it into a little bit of perspective. And the reason we are maybe a little more jittery this time is we haven't seen this impact in the market for quite some time. We haven't seen a downturn, but quite frankly, there's quite a few downturns. In fact, we average more than or close to one a year since the 1920s of 10% or more in the market. We're currently about an 8% downturn. It wouldn't surprise me to have it go down another 5, 6, or even 7%. However, each time we do tend to recover, and I don't think this time is going to be any different, whether we come up with some kind of cure for Ebola, that Ebola virus, or some way to quarantine it or nip it in the bud. Whatever we decide, whatever road we take, it'll be a positive road, just like it has been before and before and before. I don't think this time's any different. I think it's just a little more, again, makes us a little more jittery because we just haven't seen any of these in the market for a while. But actually the average downturn is actually around 16 to 18%. And like I said, we've had one almost every year. So again, I don't think this time's any different. In fact, I think there's quite a few positive things that we can look to in the market. Let's talk about some of those things. The S&P 500 forward price earnings ratio has dropped to 14, which is in line with its 10-year average, and actually a 4% discount to the 20-year average of trailing earnings. So right now, we're just right in that average. Since we've dropped 8%, the market is, it's just right in line, okay? Stocks are still favorable relative to bond yields. Clearly, bond yields are very low. Typically, when we're in this type of position and bond yields and yields are very low, the market can take a little bit more PE ratio, or I expect to see some expansion in the market. Okay, October 15th, 2014, which was just yesterday, the advanced decline line on the New York Stock Exchange was positive, even though the market indices were negative. So the S&P finished down for the day, right? But that means there were more stocks up than there were down. That's actually a very positive sign. It doesn't mean we're out of the woods. In fact, it may mean that maybe we're base building a bit here, and hopefully, we're getting a little meat on our bones here and trying to find some kind of common ground, where we can start base building from there. The Russell 2000 yesterday was positive for much of the day. We've seen clearly we've seen a deterioration in small cap stocks, although we have not seen that the last few days. In fact, it's been just the opposite. And oftentimes that's a good signal for us, and I'll show you a chart a little bit later that'll be really interesting. That shows us that a lot of the times those will come back. The other thing I'd like to mention is this is a midterm election year, and again I'll show you some more information on this. But in midterm election years, unfortunately, we tend to see these types of ups and downs and dips and whatnot. Okay. The last thing I'd like to mention is averages are just that. We can be higher or lower, and the risk reward based on those averages in a less than 3% inflation environment, which we're in, okay, the average since 1957, the risk on average to the market is about 15%, okay? So it wouldn't be unjustified for the market to correct 15% to shake out some of these cobwebs and then obviously to move higher. Okay, so let's talk about some of these things. And this slide, is it time for defense? Well, over here on the far left, as you can see, the far left bar, which is blue and it's moving upward, that's the first basically 300 stocks. And this represents the S&P 1500, so 1,500 stocks. The 1 to 300, those are generally positive through October 6th. The ones on the far right, the smaller ones, have actually been negative. And in fact, as you can see, they're down about 10%. So clearly there's been this bias towards the large stocks out there. But this is the chart I was referring to a little bit earlier. Okay, this is based on the stock market's annual and presidential cycles combined, okay? So the S&P 500 annualized total return 1926 to date during midterm elections, I know you can barely see that, but this top chart, it says we are here. And basically it means through this midterm election period, through March through October, we're generally relatively flat. But as you can see, we actually average about a 24% return November to April after that midterm election cycle. And I think I really believe that this time is going to be no different. The chart down in the bottom right shows the stock market's annual and presidential cycles combined with small cap stocks. And as you can see clearly, it's actually a negative return, but yet its return in that November to April time period is 34%. So obviously the small cap stocks tend to swing a little bit more up and down, but I think this is a very positive sign. And you may say, well, Troy, how's it positive? I mean, if the small caps are negative. And it's because it's not that they're negative, it's because this is normal. I mean, if it was something other than normal during this period of time, unfortunately, the month of Halloween, we tend to see a little bit more volatility in stocks in October, up and down. Okay? So if we look at it kind of on just a cumulative basis of the S&P 500 during the presidential cycle, we can kind of see this blip here where we tend to go down somewhat in the market, and again we're right here, but look at these returns, these typical returns right after the president, after this tumultuous time per se. And believe me, the Ebola outbreak and things like that, they clearly aren't helping. Europe's softness in their economy, the strength in the dollar. There's a lot of things like that obviously are clearly lending to some of the scares and fears on Wall Street today. Okay. However, one thing I think we have to look forward to, and like as I'll mention, stocks are still performing very well. Companies like Johnson & Johnson just beat earnings, raised guidance, and said they're going to do better. Well, that to me does not sound very bearish. I mean, we can add other stocks to that list: Goldman Sachs, United Health, United Rentals, Skyworks. I mean, these companies those are just very typical of what we're talking about. Those companies are actually doing very well. And in fact, as you can see, is what this graph shows, it's basically whether earnings are higher or lower than the same quarter the previous year. As simple as that. Are they higher or lower? Are companies making more money or are they not making more money? And there has been periods of time when clearly they didn't make more money, and periods of time when things got quite a bit softer. We are in a slower economy. And yes, the dotted line represents the average that goes right across the middle of this chart. However, I would like to mention to you that it's still positive. It's still doing very well. Okay, so the earnings reports, even though I mean we don't see the real high numbers like we have in the past, we're chugging along at a good pace. We've even seen employment numbers this morning reported, and they were very positive. Okay, I show this chart quite often, and I really like this chart, but we did have a period of time where bonds, and negative performance in the market. So we had a 10 to 16 years of negative performance in the stock market, all right, at a rolling period through 2008, 2009, and where we had bonds outperforming stocks in that same period of time. When that happens, it generally means we are expected to see about a 20 to 25 year upcycle, and I think that's where we're at now. We've seen from this bottom in 2008-9. We have seen an upturn of about 200%, but I think there's clearly more to go. In fact, I would generally say that we have somewhere. I mean, as you can look back, there we were at 500%, 569%, 484%. Obviously, time will tell, but I do think we're still in this upcycle of 20 to 25 years. The other major concern out there is, the Fed. I mean, are they going to start to tighten interest rates? Frankly, I think the answer is no. I think this recent scare here is really kind of setting them back and having them say, gosh, you know what, maybe we're not going to tighten, but, we're not going to, hopefully they won't do another quantitative easing. But the money is already out there, okay? The first time in 2008 and 2009 we had a credit problem. There was a liquidity problem in the market, okay, not only caused by the housing, but also in the credit markets. We don't have that this time. In fact, there is no liquidity crisis. So generally speaking, as this chart represents, the blue line is in the previous 5 times when the Fed was getting ready to tighten. You can see that the market actually initially starts to decline, but ultimately from there it rises, and over the next year rises to the tune of about 20%. So I don't think this time will be any different. Again, these are the last 5 times. The gray shaded line is kind of our current line, and as you can see, it's pretty much the same. In fact, if we were to throw in this little dip here, we'd be right in line with everything. So we continue to see the S&P 500 trending upward, although there are going to be setbacks from time to time, and this is no different than some of those others. Again, mad cow disease was very scary. SARS, the swine flu, the Asian bird flu. I mean, over and over and over, we've seen these things happen quite a few times. Unfortunately, this outbreak, if we're looking at West Africa, is very severe, and clearly, I hope there's some remedy coming soon to this, because I think the fear and the more cases that we see here in the United States will continue to put that fear into folks, and it'll be tough for us in 2014 to get back to that mid-barrier level of 2040 on the S&P 500. Although I do think it's possible. We do need the market to get on some solid footing here over the next few days, and hopefully this advanced decline line stays positive. And I think if that happens, and even though again we could see another quick downturn in the market, I think that will lend itself to some increases towards the later 2 months of the year in November and December. So with that being said, I just want to give everybody kind of a quick update and outlook of what we're thinking here at Archer Investment Corporation. I know many of you, this is clearly on your mind, where the investments are and how we're doing. I continue to believe that we are looking for opportunities in the market, and opportunities in the portfolios. However, it doesn't make sense to try to sell Pepsi at a price today and try to buy it back at $5 less tomorrow, because that means you have to be right twice. It's much easier to be right once and buy a stock and hold it for the next 5 to 10 years. For those of you who are retired, you say, hey, I can't afford another 2008, 2009. We understand that. That's why, again, we always stress kind of more of a moderate type portfolio of asset allocation. But at the same time, the day you're going to retire, you're not going to pull all of your money out on that one day. No, in fact, retirement lasts for several years, decades even. So, we want to make sure that we're invested for the long term, and that we have allocated those portfolios correctly. So, with that being said, I appreciate everybody's time today. I know this is really brief, but I wanted it to be quick. And if anybody ever has any questions, feel free to contact not only your advisor locally, but you're more than welcome to contact us if you have any additional questions. Thank you, and have a good day. Bye.